Good morning, everyone. Barry Knapp from Ironsides Macroeconomics. It's Monday morning, July 14th at 7 a.m. Mountain Time. In a very quiet week, last week we've managed to find plenty to say, in particular because what's coming up in the next 3 weeks should be exceptionally interesting, as we put in the email associated with this video. This is the point when the detox, slowdown in government spending, and tariff-related pressure on margins, chaos may really hit the fan. I was an old colleague of ours whose English was a second language who made that statement. It's kind of an inside joke, but never really always strikes us as kind of funny. So we began the note with a section we titled Fasten Your Seatbelts. We are really getting into detox crunch time and the impact of the tariffs crunch time as well. We're going to get CPI, PPI, and import prices this week, as well as big bank earnings and the retail sales numbers. So we'll get a bit of a picture on what's the impact of tariffs on margins, what's the impact on inflation, and then just how much has the potential price increases impacted consumption. Obviously, we've had much slower growth. We took a look at the Atlanta Fed tracking estimate, not in the way most people do, just looking at the headline. We actually dug through the numbers, pulled out the effect of inventories and the effect of trade policy, and see that PDFP, one of the Fed's favorite measures of just core growth, right? Final sales to domestic purchasers is running at about 1.3% in that tracking model estimate. That's similar to what we wrote last week, that we saw coming out of the labor side of the economy, essentially no increase in aggregate hours or hours worked in the second quarter, which would imply growth is only a little over 1% or so. We then get quite a bit more earnings and data the following week. We're going to learn more about business confidence and whether it's recovering now that OBBBA has been passed. And then the final week of the month is just going to be really interesting with employment data, GDP, big tech earnings, and a bit of a sleeper event. We're going to get the testimony to the appellate court on the Court for International Trade's decision that the use of IEPA, the International Emergency Economic Powers Act, is unlawful for implementing reciprocal tariffs. So all that'll be quite interesting. The market, obviously, stock market continues to look through this soft patch towards a recovery in capital spending. That's why the industrial sector continues to perform so strongly. We've been recommending through this period that you be long sectors that will benefit from a recovery in capital spending, and you avoid sectors that are direct consumer-facing sectors, namely the discretionary and staple sectors, where we think there will be margin pressures. Core earnings are likely to be fairly weak. We then moved on to a broader discussion about just why inflation is not going to accelerate in this environment. We began with a bit of a review of what happened in the 70s. It's not all Arthur Burns' fault. It really began with LBJ and Nixon and the Great Society programs. Inflation is always and everywhere a fiscal and monetary phenomenon. And we compared and contrasted the environment in 21 to the environment in 2025. And they're decidedly different on both the monetary and fiscal policy front. So to really get into the details of that, become a full subscriber, and you could read these notes with all the detail. We then had a discussion about the Fed's balance sheet based on a very interesting speech by Governor Waller last week. Again, if you're a subscriber, you could get our take on it. Otherwise, if you're interested in the topic, have a look at his speech. It's an interesting perspective. We would have liked him to discuss the impact of the Fed's balance sheet on the capital allocation process. He didn't do that. His framework was trying to match the Fed's assets and liabilities. It's a viable framework, but it's incomplete. Still, it brings us towards what we've been recommending, which is the Fed shrink or reduce the duration of their portfolio, stop holding so many longer-term securities, and impairing what we think is the most important price in the global capital market system, the rate on the 10-year Treasury note. We do think they're getting very close to a rate pivot. Obviously, if we have a fifth consecutive downside surprise in inflation list this week, we'll get that. And maybe not in July, but certainly in September. And we went through the details of the inflation report a little bit. We do think a downside surprise is likely again. And then concluded the note with a discussion of the energy sector and big bank earnings. We had a couple of events last week that were worth discussing. We spoke at Denver Oil Executive Lunch and relayed our comments and the feedback and discussions we had down there in the note. And we do continue to like energy stocks. We do think that the president may become a little more tolerant of a higher oil price. Drill, baby, drill, and a $50 price is not going to lead to U.S. energy dominance. We need a higher price in order to be able to invest in the infrastructure and invest in all sorts of alternate sources of energy in this country as well. So that's it for me this week. Have a good week. Barry Knapp from Ironsides. Again, consider becoming a full subscriber, and you'd get updates from us during the course of the week. You get the full notes and a more detailed even summary on Monday mornings. Barry Knapp from Ironsides. Thanks.